You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The futures markets can be downright scary. Limit up, limit down. What the heck is RBOB anyway? Are they going to dump a truckload of soybeans on your front lawn if you click the wrong button? Come to think of it, maybe you should just stick to your comfort zone. Or you can break out of it with the Futures Rundown. The Futures Rundown is here to help you make sense of these scary markets. We'll analyze all the top futures trading activity, explore the ins and outs of your favorite products, explain exactly how futures work, and hear from leading experts in the futures markets. We'll even tackle all of your wildest futures trading questions. If it involves futures, then you'll hear about it on the Futures Rundown. The Futures Rundown is brought to you by T4 Futures and Options. Elevate your trading experience with the T4 Futures and Options trading platform. Whether you prefer desktop or mobile applications, T4 delivers low latency and professional-grade functionality for both traders and brokers. Take advantage of theoretical sheets, strategy solver, MBO, advanced charts, and a suite of powerful features to enhance your trading strategy. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. And now, it's time to break into the futures markets. It's time for the Futures Rundown.
All right, everybody, that music means we are back with yet another episode of the Futures Rundown. Hope you're having a good trading week out there. Listeners, my name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which all of you folks are binging these days. Hope you're doing well in now 1 week post-election fallout. Hope you recovered. If you were upset, if you were happy and partying, hope you recovered on either side of the fence out there, listeners, and hope you're having a good trading week this week. Remember, of course, if you want to keep supporting the show that is coming at you, check out our friends over there at T4 Futures and Options, aka ctsfutures.com. Or just type T4 Futures and Options into Google. You get a free month. Tell them you heard about us on this show. They'll be happy to hear from you. And of course, if you want more, head on over to our pro, theoptionsinsider.com/pro. That'll get you access to a bevy of exclusive content there, including great pro Q&As and some great unusual activity, giveaways, all kinds of fun. And speaking of fun, it's always a fun time when I am joined on the program by our old pal doing back-to-back weeks here on the show, Mr. Dan Gramza from Gramza Capital Management. Mr. Dan, welcome back to the program, sir. 2 in a row. How'd you make it happen?
Well, thank you very much for the invite. It's always great to be with you, Mark.
And it's always great when we get to tackle a little Futures 101.
It's time to shine some light on this mysterious marketplace. It's time for Futures 101.
All right, listeners, Futures 101, the portion of the show where we tackle some futures-oriented concepts, maybe some terms that are confusing, maybe a little bit scary, and we break them down in a little bit more detail for you out there so you can be a armed and prepared futures trader. And this week's one is a bit of a doozy. It's an interesting one. It's an old school one. And depending who you talk to, either a very important one or one whose maybe time has potentially passed it by. What am I talking about, listeners? Well, I'm talking about the COT Report, aka COT, the COT Report, aka the Commitments of Traders Report, put out by the CFTC, aka the Commodities Futures Trading Commission, aka the regulatory body for all things futures here in the US. Listen, what the heck am I talking about? Well, this is a report that the CFTC puts out every Friday. So it comes out Friday at 3:30 p.m. Eastern, 2:30 p.m. in the one true time zone here of the central time zone here. Now, weirdly enough, it's not from Friday's data, which is where some of the fun comes in and some of the lingering questions come in about this report. They're giving it to you every Friday at 3:30, but they're giving it to you as a breakdown of Tuesday's open interest for futures and options positions on these markets. And pretty much any market that has large positions, they have specific reporting levels for each product out there, listeners. And as long as it's above the size which they require to be reported, they will include it in their report. So, Dan, I've already said a mouthful, and we're just getting started. I can see a lot of our listeners' eyes may be rolling as, what the heck are they talking about? But let's start. You've been in the futures game for a while. Where do you fall on the COT Report? Do you use it? Do you find it's a useful tool still in the modern era, or is this kind of antiquated data?
Well, whether it's going to be helpful or not depends on your time frame. If you're going to be day trading, it's probably not going to help you too much. If you're swing trading, where you're trying to hold a position from 1 day to 3 weeks or a few months, it may give you some guidance. But there are some challenges that come along with it. But first, let's talk about what you gave us there, Mark, and that is it gives us different classifications of traders that participate in the market that have positions over what they call reporting levels. And why does the CFTC want this anyways? I mean, shouldn't your stuff be private? Well, they want it because they want to make sure that no one's trying to corner the market. No one is having a position that's gigantic. Now, you can have a gigantic position way beyond the reporting levels if you're hedging. So if you're hedging, there's no limit. As long as you can show that you have risk that you're offsetting. Now, if you don't have that, if you're just speculating, they also want to know, how big is this position getting? I can tell you something that comes to mind now. This is a while ago, but this was like late 80s or late 80s. And it was an Italian company called Ferruzzi. And Ferruzzi was amassing a position, if I remember correctly, it was soybeans. And because of this report, the CFTC said, and the exchange said, well, hold on a minute. What's going on with this position? And they said, well, we're hedging. And they said, well, show us the exposure that you're hedging. And they said, well, we have a few extra contracts. They said, no, not acceptable. Reduce your position. Because they had a lot more contracts. And so they had undue influence potential in that market. So that's the idea behind this. It's a way for the regulator just to make sure there's no one with getting a position that's out of alignment. In other words, if you're a speculator, they're going to monitor once you're above the reporting level. If you're a hedger, that's going to be different. If you're a commercial and you can show that you have exposure, that's different. But they do monitor it above reporting level. And as Mark said, every market has a certain reporting level. And I remember I used to manage money in Hawaii, and most of our futures positions had reporting levels that we had to make sure we're complied with. We'd have to notify our broker, and the broker would have to notify CFTC. I'm sure it's all automated right now. But that's the idea behind it. Now, let's go back to the other point that you brought up, Mark. And that is, well, hold on. You're telling me that I get information on Friday for Tuesday's information. Isn't it kind of stale by that point? Yes, depending on how you're going to use this information. If you're trying to get a general feel for what's happening for these different categories, if you look at commercials, that's one category. And these are going to be the people that produce and process a product. They're going to have exposure, and they can show that they're hedging. And then you have non-commercials, which means they're not going to be hedging. They're going to be speculating. And then you have people who have non-reportable positions. So those would be speculators, and it's going to be smaller positions. So the idea being, what happens if you and I look at this report, not one point in time, you really want to see it over time. You want to see, is there a trend? And one point doesn't make a trend. So we'd say, something, for the last 3 weeks, commercials have been selling. And you and I were thinking about buying this market. Should we be concerned about that? Well, here is the tricky part. I remember at the Board of Trade floor, like in beans, they'd say, Cargill just sold 300,000 bushels of beans. And you hear that and you go, whoa, Daddy, that's pretty bearish. Well, they have a position of 600,000 bushels of beans. So are they still long the market? Yeah. They're just unloading some of their position. And that's something to keep in mind when you look at these reports. And we don't know what the total position is of that commercial. Are they just reducing position? Are they adding just a little bit to a gigantic position? Or are they just starting out building a position? We don't know those other parts. So you got to be careful, I think, in terms of how you use that information. Is it a broad, general point of view of what commercials, non-commercials, and non-reportables, the small guys, are doing? What happens if the small guys are just buying the heck out of this market, and you and I look at it and we go, geez, they're buying it, but non-commercials, these other speculators, they're selling it. Are they selling it because, again, they're bearish? Or are they selling it because they're lessening their big, long position? And I think that becomes the challenge of this report. It is dated in sense of timeliness. It may give us a feel for what's happening in a general way in terms of reportable positions by these different groups. It can give us that. And then a lot of people would say, well, doggone it, why not just do it throughout the information. Come on, report it during the day. Now, I have to tell you, a liquidity data bank report is also a CFTC report. They don't publish it anymore, but they collect the data, and they used to release that every 15 minutes. But they don't do that anymore. The exchanges would do that. But so is it possible? It is. The data's there, but it also goes back to, they're making a decision to do it. It could be economics, and it could be for some other reasons that they don't want to provide that information in a timely way. So that's kind of a general overview, I guess, of how I think of the COT report, the COT report.
You call it the COT. I've always called it the COT report, sir.
Yeah, either one.
I've always been a COT report guy. I
Yeah.
blame Eric Cott. He got me into that. But but yeah, you tackled a lot of interesting things. I just want to hit on a few of those. For example, the reporting levels. You may be saying to yourself, do I need to report? And for 99.99% of you listening to this show, the answer is no, listeners. But it does vary by product. So if you're trading some pretty illiquid stuff, like we just pulled up some CFTC random reporting levels, and to give you a taste, a sample, let's say something pretty illiquid, like the 1-year Eris SOFR swap. Doesn't trade a ton, listeners. So if you have 25 contracts in that, you need to report those out there. Now, something a little bit more liquid, let's go out to the 10-year, which prints contracts all day long. Now you're talking a little bit different. Now you're talking about 2,000 contracts to be the reportable level out there. So again, just something to bear in mind. Not a lot of you out there who are listening slinging 2,000 lots of the 10-year, but hey, if that's the case, more power to you out there. Just something to bear in mind. Like everything else in the futures market, it's going to vary by product. And if you're going to trade a certain product, you should know all the mechanics and logistics and specifications therein, including the reporting requirements. Dan hit on the report frequency. This is a question people bring up a lot. In fact, it's so common, Dan, they have a section on it on their CFTC website. They say, can you release the COT reports more than once a week? They have that question up there in bold. And they say no. They say because of easy for me to say, because of resource constraints, we are currently only able to release this report once per week. And Dan, you talked about their liquidity database that they keep. Do you buy that? You think the CFTC is resource constrained? They could really only manage this once a week, Dan? You believe that?
No, I don't. I don't, because I'm taking it back to the 80s when they released the liquidity data bank report. Now, that was once a day at the end of the day. But eventually, in the early 90s, that was released every 15 minutes. So no, I don't agree with that. They don't have the funds to do it. I'm not sure what the apprehension is about that. Maybe they don't want it to be used as a speculative tool. I'm not really sure. There's no identity of who's participating. These are all gross numbers. You're seeing, how much is spread, how much is managed, it's. I don't see, there's not a confidentiality issue. And personally, but I will say one thing, and it's one of the reasons they stopped issuing the LDB reports, because I was involved in trying to get them to do that, issue it more. It's because nobody was using it. They didn't have the consistent demand from a very large audience that knew how to use it. So people would look at it and go, okay, what do I do with it? How do I trade it? How do I implement this information? And what's important, what's not important? And so I think there was a lack of use than it is a funding issue, my opinion.
Yeah, Dan mentioned a couple of other things. The categories within the report itself, there's pretty much 3 major quote-unquote categories. Even if you look at the modern COT report, there's kind of even more. They break them down into subcategories. We'll get there in a second. But the big ones are going to be commercial. So, of course, your producers, maybe you're out there and you're a sugar farmer. So you're out there producing sugar, or maybe you're an end user on the flip side. On the flip side of sugar would be someone who buys it. Let's say Coke, going to put it in a lot of their soda, whatever the case may be. So that you be a processor on that side, or maybe the non-commercials, but still size, like your hedge funds, your CTAs out there who are putting on large speculative positions in these products. And then there's a lot of the retail folks out there, the non-reportables, the smaller speculators, and folks out there like a lot of you listening to this show. And as Dan already mentioned, the use case for the COT report is kind of very specific. If you're out there doing a lot of intraday swing trades in the E-mini, COT report not going to be for you. It's obviously very lagging data at that point. But if you're looking for longer term trends, and maybe you're trying to spot the inflection point within that trend, then the COT report could still have some residual data as much of a lagging indicator as it is. Now, Dan, I wanted to bring up some specific examples for folks, because if they just go to the CFTC website and they download the most recent COT report for whatever product, I happen to pull up WTI and silver here, but you could do this for any product you want, listeners. So these are going to be, if you're listening to this down the road, these are going to be for late October here, in particular the October 22nd report, listeners, for WTI and silver. And if you did that, listeners, you'll see these subcategories that I'm talking about. Also, you're going to be probably confused because the format for this report, Dan, looks like it was constructed out of ASCII characters from like 1982. It is the most impenetrable. This is the most government report I've ever seen in my life, Dan. It's like they don't want anyone to look at this thing. It is ridiculous. It's like a dot matrix printout from 1983. What are they doing? This is terrible. So they want you not to use this thing. But it has these categories at the top you will see, listeners. Like we're looking at WTI right now. First category, getting into those producers and end users. They have producers, merchant, processor, and then user. And then they have them broken down further into long and short. So they break it down into who's long positions, who's got short positions. In the case of this report, there were 612,000 long positions open in WTI and 402,000 short. They also show what percentage of open interest they are and how many traders are in each category. In this case, the longs, there were 61 size reportable traders and 67 on the short side, which is interesting. Then they add swap dealers, which is an interesting kind of newer addition out there. Not as many on the long side there, 47,000, but the short side of the swap dealers are in for size, 487,000 short contracts. And then another category, which is spreading. So how many of those are involved in spreading? The 215,000 more of those. Then we get into the managed money. So the quote unquote speculators out there, 163,000 long, only 49,000 on the short side, but 438,000 involved in spreading, so size on the spreading there as well. And then we get into the quote-unquote other reportables category. And there's 118,000 on the long side, only 27,000 on the short, but again, very active in spreading, 522,000 there. So Dan, first off, what are your thoughts on this nearly impenetrable formatting that they use? They could at least update it to, I don't know, a modern font or something. And then B, these different categories, the producers, the long and shorts, the swap dealers, the spreads, and all this other seemingly impenetrable jargon, Dan.
Well, I agree with what you're saying. The format probably could be updated a bit, but once you get used to it, it's really not too bad. But what's great about you picking WTI, spreads are very common in this market. And you can see that in every category, there's quite a bit of spreading going on. So that kind of fits the market that we're looking at. So not too surprising. But what's also interesting in this report, if you look at who has the biggest position on the long side, and it's the producer. The swap dealer, they were on the short side. Managed money, they're on the short side. Non-reportables or other reportables, they're on the long side. So you have that smaller trader being long, and you have the very large player, the producer, being long. But swap dealers and managed money, they're short. And basically, and that's what this kind of gives you an information of. Where is the flow, and are they long or short? And that's the way you can try to extract some information from this. So, if you have an option position, for example, and you want to think about time and what you typically hold that position for, and if you can look at this and say, there's a bias here. And the bias on the commercial side is the long side. And then you have to ask yourself, who's right most of the time? Is it the swap dealer? Are they right most of the time? Or is it managed money? Is that smart money? So should I follow their footprints? Typically, it's the first category. It's the producer. Where they go, so goes the market, in a sense. That's the old saying for it. So then we could say, all right, we're going to follow their footprints. So I want to have a bias to the long side. And so it's a way to kind of extract some info from what we're looking at. But as far as format goes, Mark, I'm not a real good person to look at an Excel spreadsheet of numbers and see something. I think what they have, okay, but show it graphically. So you and I could look at this and say, you know, over the last month, this is what these categories have done.
You know, I think
that would be more helpful.
That's a good point. I think a lot of people who are hardcore, quote unquote, users of the COT report that I've seen, they look at it graphically. Either they have a platform that does it for them, or maybe, God forbid, they do it manually themselves. That's a lot of entry. But there are a lot of people who use these, especially for that purpose we were talking about earlier, you know, trying to find the trend and then, you know, trying to find the change, the inflection point in that trend. Those people tend to look at it graphically over time. I think it's a lot more digestible in that format, Dan. So folks will have to go to a platform that offers that. Hopefully, maybe your futures broker will offer you that data out there, because this disaggregated ASCII format, Dan, is for the birds. It's terrible.
Yeah, I agree.
Let's do one more quick hit here for folks here. October 22nd, same report date list. Let's do a smaller product. Let's do silver. Obviously, and not as much volume out here. Same categories: your producers, processors, users, swap dealers, managed money, and other reportables. We're going to have long and short and spreading for most of them as well. So silver on the October 22nd report, nearly 10,000 long positions, 49,000 short. So that's kind of interesting. They got run over the last week and then are getting it back today out there. That represents 10 reportable positions on the long side, 22 on the short side. Swap dealers, 23,780 on the long side, 69,000 on the short, and 11,000 in the spreading. Managed money, 56,000 long. So folks are long some silver out there. Only 9,300 short and 15,000 on the spreading side. And then other reportables, 25, almost 26,000 long, 8,200 short, and 43,000 spreading. So obviously a little bit smaller, a little bit more manageable, a little bit more bite-sized. So it might help you if you're intimidated by the COT report, maybe starting with a smaller, more bite-sized product like silver before you leap into not even WTI, let alone like the 10-year or some of these other beefier, larger products. Dan, anything else to add on the silver COT report before we roll out of here for this week, sir?
Well, no, the only thing I would say is it goes back to looking at something graphically. So if you had this data over time, and you got to keep in mind this is delayed data, but if you had it graphically, then you put that next to or on top of the market, the underlying market, so the silver market, and then where would you see what tracks the silver market the best? And that may be an indicator of which one of these categories you'd want to follow for our friend, Mr. Silver.
All right, listeners, so there you go. A deep dive into the mysteries, the madness, the just sheer frustrating font of the COT report, listeners. Yeah, so don't be intimidated if you see that horrible, non-digestible report on the CFTC website. There are platforms that will help you make it a little bit more digestible. I can certainly recommend getting behind the graphical approach. Might make a little bit more sense, more easily digestible, and also you can spot the longer term trend a little bit more easily that way as well, which at the end of the day is going to be the predominant use case of these reports. If you're doing intraday swing trading like we were just saying, probably not a tool you're going to rely on. Also, if you're hoping the CFTC is going to up their game and start releasing daily COT reports or intraday, don't hold your breath. Seems like they're sticking to weekly for the foreseeable future. And also, if you download that report and you see this ASCII monstrosity, just be forewarned and forearmed out there. It's not as scary as it looks, but when you first approach it, it might be a little bit intimidating. And Dan, in the meantime, if folks are listening to this and they have more questions about the COT report or really any other aspect of the futures market, where should they go? What should they do, sir?
Well, they could send me an email if they have a question at dangramza.com under support. That'll get to me. If they're interested in looking at futures, I do a daily video. It's watched in over 150 countries, and it's free. It covers 6 different sectors, 22 different markets. You'll see red and green lines, which represent buy and sell levels. From my point of view, these are not recommendations, but it gives you an idea to see, all right, how did the market react to these levels? And you can go back over 10 years and see what happened in the past. So what did I do with those lines, and how did they move, and how did they unfold? So it's another way just to get a feel for a variety of markets. The 2 markets that we talked about today are in that complex that I look at. So you can get a feel for how do they move. Are they crazy, or, hey, it's not too bad at all in terms of volatility. Not worse than any stock that you have in your portfolio. So that's one potential resource, is that website. Oh, and if you want, you can get an email every day that tells you when the report is uploaded.
There you go. Get that email, listeners. DanGramza.com, GRAMZA.com, the place to go to kick the tires and light the fires. While you're kicking the tires online, listeners, make sure you head on over to ctsfutures.com or just type T4 Futures and Options. That is their platform in Google. That'll get you access to their platform. You can register for free, get a free month. A lot of great tools there, including some interesting stuff on the COT Report. You should definitely kick the tires and light the fires and check that out for yourselves. And hey, it helps support the show that you folks are loving out there. So thanks again for listening. Stay safe out there, and we'll see you back here next week, another episode of the Futures Rundown.
Thank you for tuning in to the Futures Rundown, proudly sponsored by T4 Futures and Options. Experience the T4 Futures and Options trading platform with its seamless desktop and mobile applications, low latency, and professional functionality tailored for traders and brokers alike. Take advantage of T4 Theoretical Sheets, Strategy Solver, MBO, Advanced Charts, and much more. Empower your trading journey with T4 Futures and Options. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.